Zikunze Manufacturing Limited is considering to raise an extra 10 million. So 10 million is what we are looking for in order to finance an expansion program. The company's current capital structure, they have given us a current capital structure. We can see ordinary shares of 50, we can see reserves, we can see venture capital, we can see 10% preference share capital. Additional information, the company is considering raising the funds using two alternative financing options. Option number one, to raise all the funds through the issue of new ordinary shares at par. Two, to raise a half of the funds through the issue of new ordinary shares at par and the balance through the issue of new 12% debentures at par. The corporation tax rate is 30%. So they want us to give them EBIT at the point of indifference in a company's earnings for each financing option. And then we give them the earnings per share at the point of indifference in one above. Thank you very much. So if I'm the one doing this question, in less than 10 minutes, this is what I'll do. I'll start with the current capital structure. Never ignore this. The current capital structure. Never ignore this. So the current capital structure, what do we have there? We have ordinary share capital, ordinary share capital, ordinary share capital, right? And then we have reserves there. We have reserves there. And then we have 14%, debenture capital, 14% debenture capital. And then we have 10% preference share capital. So this one is 50,000 in thousands. Reserves there account for 20,000. Reserves account for 20,000. We have 14% debenture capital accounting for 20,000. Right. We have 10% preference share capital accounting for 10,000. Now, as a bright student, I know that whenever I see ordinary share capital, I will need the number of ordinary shares. So here I will come and calculate the nose. So could you kindly give me the nose in this question here? Could you kindly give me the nose in this question? How do we get number of ordinary shares? How do we get number of ordinary shares? It's very easy. You take the share capital given, you divide this by the par value. You take the share capital given, 50,000, you divide this by the par value. Have they given us the par value? Par value of this share capital, yes, 20. So somebody is giving me 2,500. Thank you very much. This is important. Whenever I see debenture or debt, I have to calculate interest. So in this case here, come and give me the interest here. So the interest will be the rate of interest given times the amount raised, 20,000. Which will give me how much, ladies and gentlemen? 14% times 20,000. These are free math that I'm getting really without sweating at all. 2,800. 2,800. And then we have here, of course, this one attracts preference dividend. So here we have what we call the preference dividend. The preference dividend. So preference dividend will be 10% of 10,000. Which will give me how much, ladies and gentlemen? Which will give me how much, ladies and gentlemen? Which will give me how much, ladies and gentlemen? Which will give me 1,000 more. Thank you very much. 1,000 more. Thank you very much. These are very important. Current capital structure is also what I call the old capital structure. Old capital structure, the existing capital structure. Now from there, they want now us to look for some more funds. They want us, if you look at this question very well, Sikunze, they want us to raise 10 million Kenya shillings. They want us to raise 10 million Kenya shillings. So, and how do we raise these 10 million Kenya shillings? We have option one. So raise Kenya shillings 10,000 10,000 using equity alone. Using equity alone. Using equity alone. So you are raising Kenya shillings 10,000 using equity. Using equity. Using equity. I'm saying 10,000 because every figure here is in terms of what here thousands, so that I don't confuse. So that I don't confuse. Right? So are you able to see my board, ladies and gentlemen? Are you able to see my board? Are you able to see my board? I can see one student complaining a bit. What would you advise Alice? What do you think would be her problem? She wants to miss a very important lesson. This is a very important lesson. Oh, it's a bit blurry, eh? It's a bit blurry. Very clear. Others are saying very clear. Does it really depend on the type of the phone or internet? Clear. So if it's clear, let's continue, please. If it's clear, let's continue. I'm supposing the ones who are saying it's a bit blurry, they're not able to see. Perhaps these are those ninjas who are making use of telecom. As the Safaricom people are very happy. So raise Kenya shillings 10,000 using equity. That is what option number 1 is telling us. Option number 1 is to raise all the funds through the issue of new ordinary shares. Ordinary shares. Now please listen and listen to me very well. I'll come and underline this. I'll come and underline this. The most important thing here when I hear of equity or shares being used, I would want to know the new number of ordinary shares. The new number of ordinary shares. Remember, how do we get number of ordinary shares out of this new capital of 10,000? They have not told us that the par value is going to be different. The par value shall remain the same. The par value shall remain the same. So it will be 10,000. 10,000 divided by 10,000 divided by 20. Par value remains the same. Par value remains the same. So 10,000 divided by 20 gives me how many shares here? Somebody. This will give me 500 shares. 500 shares. So remember here that interest will be 0, and the preference dividend will also be 0. Why? Because we are raising everything through shares. So you're not increasing debt, so there is no interest to be incurred here. We are not increasing our preference share capital, so no preference dividend. So please come and give us the totals here. Please come and give us the totals. Come and give us the totals. Very important. The totals is very important. Give me the total news. So remember, total news will be old plus new. Old plus new. Total news will be old plus new. So the old from the old capital structure shares that we have were 2,500, you remember. 2,500 plus the new ordinary shares, which are how many? 500. So then this will give me a cool 3,000. This will give me a cool 3,000. At the same time, these three aspects are very important. Number of ordinary shares, interest, preference, dividends. Very important. Come and give me total interest. Give me total interest. We are taking the old plus the new. So old interest here was 2,800. The new in this option number 1. If you are going to use option number 1 to raise capital, then interest, as you've seen here, will be 0. Interest here will be 0. Interest will be 0. So in this case here, 2,800 plus 0, this gives me 2,800. And then we have the last one, which is a total dividends. Total dividends. Total dividends. We have here 1,000, or rather 1,000, yes, plus 0 there. I'm not able to understand Alice's question here. Alice is asking whether, not able to understand that, because you know this is 10,000 because you have chopped the 3 zeros. It's supposed to raise 10 million, but you can see all these figures are in terms of thousands, right? So this is very important. Once I reach here, ladies and gentlemen, then automatically I'm at home. I'm at home And of course, dry, home, dry, home, dry, home, sweet home. Why am I saying that? Because now I will be able to write the EPS equation for the point of indifference. EPS equation for the point of indifference. EPS equation for the point of indifference. So then how do we get this EPS? EPS, ladies and gentlemen, remember what I taught you here yesterday. How do we get EPS? To get EPS, we shall take EBIT minus who? Minus interest. Into what here, somebody? We must less tax there. And then we subtract what here, somebody? We subtract preference dividends. We subtract preference dividends. Remember, preference dividends can never be taken to the tax bracket, right? Can never be taken into the tax bracket, So divide this by the number of ordinary shares, the total number of ordinary shares, Remember, interest, they gave us from the capital structure, 20,000 loan borrowed, and the rate of interest is 14%. So we did our calculation here, we said 14% times 20,000, which gave us 2,800 there. So then EPS1 will be equal to who? Of course, we don't know what the EBIT will be. So I'll come and leave this EBIT there. Minus interest. Are you able to see the interest amount? Yes, total. Remember, don't work with the old or the new alone. Total. Total interest amount is 2,800. As this examiner given as the rate of taxation, do you know the rate of taxation from the last point? Rate of taxation from the last point, 30%, isn't it? So 1 minus 30%, this gives us 0.1 what here? This gives us 0.7. This gives us 0.7. This gives us 0.7. In this entire scenario, are we going to have any preference dividend? The total preference dividend? So remember 0.7, we've taken 1 minus 0.3. 1 minus 0.3 gives us 0.7. So minus preference dividend, what is the total dividend? It's 1,000. Thank you so much. And then everything to be divided by total number of ordinary shares. Do we know the total number of ordinary shares? 3,000, isn't it? Total number of ordinary shares are 3,000 like that. So then could you kindly go ahead and open now brackets for us to be able to get the most simplified equation? For us to be able to get the most simplified equation, how do we get, in this case here, what figures do we get on opening brackets? Ladies and gentlemen, abracadabra, our EPS for option 1 here. Our EPS for option number 1 will be equal to this 0.7 will multiply this. So this gives me 0.7 EBIT. So this gives me 0.7 EBIT minus, how about this times this? This times this. This times this gives me how much? 1960. The year I was born. 1960 minus 1,000 remains. Divide this by 3,000. Divide this by 3,000. Divide this by 3,000. Divide this by 3,000. So then at the end of the day, I can see my own putting up his hand. So EPS1 would be equal to 0.7 EBIT minus this minus this. And you know here, Saturn is real. Saturn is real and Saturn exists. We need to be chasing away this. I don't know why they say he's a gentleman. I don't know. Devil. Yeah, we need to be chasing him away. Often you'll get somebody coming and saying, yeah, minus 60. You ask her, why are you saying minus 60? That I took 1960 minus 1,000. There's a minus. This is minus 1960 minus 1,000. So it's supposed to be minus who? Somebody here, minus 2960. Minus 2960 like that. Thank you very much. All over what here? All over 3,000. All over 3,000. So then could you kindly come and block this? This is very important. EPS for option number 1. So can I then pick now the questions that you guys are asking? Which questions do you have now? Which questions do you have? Good questions. Any question I can see around the same question. If I try scrolling back here today, there are so many comments, which is very nice. It will be very hard. Reserves treatment. Reserves will not come really anywhere here. Reserves will not come anywhere here. There is a debentures also of 12%. Mayom, are you mixing issues? Remember, the 12% debentures, when is it coming, Mayom? The 12% debentures is coming in option 2. And we normally handle options separately. We do deal with option number 1 to the end, and then I will take option number 2 to the end as well. Right. So I hope I've answered your question. Any other question as we proceed? Any other question as we proceed? Okay, are we together up to there? I would want to see by a show of hands or a show of thumbs up or a show of thumbs down. Are we together? Great. Thank you very much. Thank you very much. It means that when I share the video, then if you were not with me, you'll be able to understand. So then we go to option number 2. Option number 2. Option number 2 is very interesting. Option number 2 is very interesting. So my now you have to be keen with this. Walter is saying like this, board blood, and I saw you adding things up. The board is blood. The board is blood. Board is blood. Let me check out. Must be a problem there. Is that a bit better now? Is that a bit better? I think that is the best I can do. Is that a bit better? Okay, great. Thank you so much. Now let's go to the second arrangement. So option 2. So then option 2, now what happens? Try to understand option 2. Try to understand option 2. We are going to have new equity and a new debt. Option 2, you're going to have new equity and a new debt. So under option 2 is to raise a half of the funds. How much are we looking at raising? How much are we looking at raising? How much are we looking at raising? 10 million or 10,000, isn't it? So out of these 10,000 in our case, because we are cutting the 3 zeros, out of the 10,000, half. So a half of 10,000 will be equity shares. That's 5,000. And then the other half will be debt. A half balance, which is a half, will be debentures, debt. 5,000 as well. Therefore, come and give me the new ordinary shares here. The new ordinary shares, the new notes. Give me the new notes. New notes. So to get the new notes, ladies and gentlemen, here, we shall take the share capital divided by the par value. Take the share capital divided by the par value. Take the share capital divided by the par value. So share capital is 5,000 and the par value really is 20 still, which is giving me 250. How about new interest? Because I can see debentures there. So new interest, the debenture that we have issued is 12%. So it will be 12% of 5,000. 12% of 5,000. What is 12% of 5,000? I'm being given a figure of 600. I'm being given a figure of 600. I'm being given a figure of 600. Thank you very much. Of course, we don't have any preference dividend here. No preference dividend. Preference dividend, preference dividend. In this arrangement, because we don't have any preference, share capital is 0. So then kindly, is it 14% or 12? Remember, we are looking at the option. Look at the option. You guys haven't taken time to understand this question. You haven't taken time to understand the question. You know, the old capital structure, we finished with it. Now I'm evaluating the option. Now I'm on option 2. Option 2. So option 2, I'm told to raise a half of the funds through the issue of new ordinary shares at par, and the balance through the issue of new 12 debentures at par. So are we together there? That's supposed to be 12%? Yes. So then come and give us the totals. Come and give us the total. So please Don't mix option 1 values here. Here we are looking at the original versus option 2 values. So when you talk of total number of ordinary shares, I will take the original number of ordinary shares. They are not going anywhere. 2,500 plus 250. This one will give me 2750 like that. 2750. Right? We have total interest. So come and give me total interest there. Total interest, I'll take the old interest, 2,800. 2,800 plus, ladies and gentlemen, in this case here, the new interest of 600. New interest of 600, which will end up giving me 3,400 like that. And then, of course, so many students will forget the dividend. They'll tell you that, now that you don't have dividend, dividend should be 0. You get a 0 as well. It's about totality. Give us the total. Give us the total dividend. Total dividend will be 1,000. The second option's dividend is 0, which will give me a total of 1,000 like that. Now, from there, ladies and gentlemen, please go ahead and give us the formula. Go ahead and give us the formula. I can now relate with what Mayom is asking there. You know, yesterday's question never had a current capital structure. These were new students who had cleared their CPA and they wanted to start a business of 3 million. And they were looking at how do we find, there was no existing capital structure. You know, the existing capital structure will have to, you will continue paying the interest unless you're told it is retired. Like there is a difference between this question and the one that we did yesterday. The one that we did yesterday. There is a difference. There is a difference. It's not a new approach. Same approach. Great. So then come here and give us EPS formula. We are repeating again. It is EBIT minus interest into 1 minus tax minus preference dividend all over total number of shares. Total number of shares. So then EPS2 will be equal to, of course you don't know EBIT. You know nothing about EBIT. EBIT minus the total interest here is 3,400. Taxation is 30%. So 1 minus 30% is 0.7. So times 0.7. Minus preference dividend, we already have this, it's 1,000. 1,000. All over the total number of ordinary shares, here you guys gave me a figure. You gave me a figure of 2750. So please go ahead and open up the brackets now. Go ahead and open up the brackets. Go ahead and open up the brackets. Go ahead and open up the brackets. Please try opening up the brackets. What do we have here? Try opening up the brackets. What do we have here? What do we have here? So when you open brackets here, we have 0.7 EBIT minus, this times this gives me what figure? 2380. Jerome is a man from Rwanda. Minus 1,000 all over 2750. All over 2750. So meaning, ladies and gentlemen, that our EPS2 basically will be 0.7 EBIT minus 3380 all over 2750. All over 2750. All over 2750. So are we correct up to there? Are we correct up to there? Are we correct up to here? Are we correct up to here? So then what do you think will be the next thing to be done? Hey, you bright students. What do you think will be the next thing to be done? What do you think will be the next thing to be done? Yeah, point of indifference, isn't it? We equate point of indifference. At the point of indifference, what do we have there? At the point of indifference, today you guys have many problems, eh? At the point of indifference, EPS1 equals EPS2. Unfortunately, I have rubbed my EPS1. Is there somebody who is able to remind us what EPS1 was? EPS1, is there somebody who is able to remind us what EPS1 is? EPS1. EPS1. What is our EPS1? EPS1, 0.7 EBIT, thank you very much. 0.7 EBIT, thank you very much. Minus 2960, minus 2960, all over 3,000. All over 3,000, which will be equal to this EPS2 now, which will be equal to 0.7 EBIT minus 3380 all over 2750, all over 2750 like that. So now from there, our role will be to make EBIT the subject of the formula. Our role will be to make EBIT the subject of the formula. So try to cross multiply there. So remember, the fewer the zeros I have, the better. If I get an opportunity of canceling, like in the denominator, like this 0 and this 0, you can do without canceling them. Whenever you have that opportunity, just cancel them out. So then this will be, if I cross multiply, this will be 275 into 0.7 EBIT minus 2960 equals 300 times 0.7 EBIT, 27.7 EBIT minus that 380. You can have others without canceling those zeros and then you compare answers. Could you kindly do me a favor? What is 275 times 0.7? 275 times 0.7. This will give me what figure? This will give me what figure? This will give me what figure? So we have Millicent, 192.5 EBIT. 192.5 EBIT minus, this has to be a huge figure, 275 times this 2960. 275 times 2960 will give me what figure? 814,000. 814,000 equals this times this, 300 times 0.7 gives me what figure? 81,400. 814,210. Remember mine I decided to cancel the zero. I decided to cancel like that. So 210 EBIT, 210 EBIT. And then lastly, we have 300 times this bad figure. A bad figure, 101,400. 101,400 like that. So then come and put those terms that love each other. EBIT, these are lovers. Put them together. 192.5 EBIT minus 210 EBIT. This one, when it crosses over, of course, we expect the sign to change. Equals minus 101,400. This one going the other side becomes plus 814,000. So then this minus this will give me what figure, ladies and gentlemen? Minus 17.5, right? Minus 17.5 EBIT equals, how about this plus that? $712,600. 712,600. I hope minus, I hope it's a negative. 712,600. 712,600. 1014,000. Is it 1014,000? Is it 1014,000? Is it 1014,000 or 101400 in my case? In my case, 1014,000. I'm being told it's 1014,000. I'm being told it's 1014,000. So this should be 1014,000. Then I believe that this will be negative. This should be negative. This should be negative. This should be negative. Yes. Is this answer correct? Is this answer correct? The students who are not really, you know, in my case, I canceled the 1 0, right? I decided to cancel a 0, right? I decided to cancel a 0. Is there somebody who can just repeat this for me? What is 300 times the 380? What is 300 times the 380? What is 300? Mine I decided to cancel. Mine I decided to cancel. In my case, I decided to cancel. 1014,000. 1014,000. 1014,000. Thank you very much. 1014,000. Then what is minus 1014,000 plus 814,000 plus 814,000? I'm being told that this is supposed to be minus 200,000. Minus 200,000. And therefore, EBIT will be equal to minus 200,000 divided by minus 17.5, which will end up giving me what figure? Which will end up giving me what figure, ladies and gentlemen, here? Which will end up giving me what figure, ladies and gentlemen? Now they're not talking to me. 11,428, 11,428.57, 11,428, 11,428.57. Thank you very much. Thank you very much. That is the correct answer. That is the correct answer. Now, having gotten this part one, this is your EBIT at the point of indifference. How about EPS? How about EPS? Already we have the EPS equation. You can see number 2, they want EPS. So Roman 2, they want EPS. Already we have the EPS equation. Already we have the EPS equation. So EPS at indifference point, EPS at indifference point, our EPS will be equal to 0.7 times EBIT, EBIT of 114, 287, 114, 28.57. I'm using this formula. Minus 2960, the way it was initially, remember. I was canceling here for purpose of what here? For purpose of equating. So all over 3,000. So is there somebody you can actually the better way is for you not to cancel, eh? Although when now these figures are in millions, although when these figures, like when you're told here, this is 30 million, this is 20 million, you forget to cancel that million. You will end up writing so many millions, so many zeros until you get a zero yourself, So then the EPS at the end of the day will be equal to 1.68, and you're done with this question. That is what you expected to do in that question. And once now you understand how to do this indifference points using this question, there is no question that can defeat you. Any question of indifference points will be okay. Then I would want to really request you that at your own time, once you get this video, try in this case here, looking at it again from the beginning to the end. From the beginning to the end. Is that okay? I'm so sure there is. Great. Great. My own, which question you had asked about? Where we having like different methods. I told you the question that we did never had an existing capital structure. Do you have any other? Never had an existing capital structure. Plot in a graph. Plot in a graph. If they ask you about graphs, leave alone that. Leave alone that. Forget those marks. Give away those marks to someone else. Where did you add new shares to EPS 1? To EPS 1. Remember, under option 1, you are issuing new shares worth how much? 10 million. Right? Which we were able to divide by 20, and we got some number of shares. Having gotten this number of shares, you must, you're looking at this thing from the totality perspective. You're the finance manager. How many shares do you have in the company? Ordinary shares. You add the 2. You add the 2. I believe if you take time, Ayom, to watch this thing, you'll be able to understand it. You'll be able to understand it. You'll be able to understand it. I wish we had luxury of time, not interest, a number of ordinary shares. My own, this thing is just confusing for now. Just take time, later on, watch it again. There is no way you can add interest and the number of ordinary shares. It cannot work. Those are not like terms. We take number of ordinary shares, old structure, plus number of ordinary shares, new structure. Interest, old structure, plus interest, new structure. That's how we go. Just take time, watch it. Take time, because if I try repeating the whole of this, If I try repeating the whole of this, these guys are insisting on a graph and I'm looking at time here. I'm looking at time and I would want to do MMM questions, but because you are the bosses, you're insisting, let's waste time then. Okay. So if we have in this case here, like this EPS, right? So we have here EPS1 equals 0.7 EBIT minus 2960 all over 3,000, all over 3,000. And you'd want to draw a graph. So how do you draw a graph? Remember, this is a straight line, right? It's a straight line, right? So when it's a straight line like this, ladies and gentlemen, how many points do we need to be able to draw a straight line? 2 points. Now, you'll start right away by asking yourself, like when EBIT is 0, when EBIT is 0, when EBIT, for example, is 0, what will be the value of EPS? What will be the value of EPS when EBIT is 0? Could you kindly try to substitute here? When EBIT is 0, right? So this will be 0 minus 2960 all over 3,000. So this automatically will translate to minus 2960 all over what here? All over 3,000, which in this case here will end up giving me what figure? Minus 0.99, right? Minus 0.99. Minus 0.99, minus 0.99. And then we have the second point. The second point, try to make use of the EPS point. I'm really hesitant about doing this. Why? The number of years I've marked these CASNEV papers, there will be very few students who will be able even to get it right up to here. Very few students will be able to get it right up to here. So you can imagine now if you have a wrong equation and you're trying to draw what here, a graph. Will your graph be okay? Will your graph be okay? Will your graph be okay? It cannot be okay. For me, these last minute sessions, they're about what here? Harvesting low-hanging fruits. Harvesting low-hanging fruits. This one will be a waste of time. It's even 2 marks. You leave it. It's about harvesting low-hanging fruits. Leave it. After all, when you go to the revision kit, I can easily send you an answer if you believe that your equations will be right. If you believe your equations will be right, to me, it's about interpretation of the question, and then we move forward. Let's do MM. Let's try to expand our horizon. Let's try to expand our horizon. Ours, in this case, is to really do what here is to ensure that we expand our horizon in terms of questions. So that you'll be able to get more than half in all the questions here asked. So then we have here MM 1 and 2. Right. And I would want to give you an example directly where we have been given EBIT of 151.52. They have given us tax 34% to confuse because they know students, whenever they are given tax other than any figure than 30%, will be able to throw most of the students out of the, under the bus. So this time around tax is 34%, right? Then they have given us debt. Debt is 500. Cost of equity of an unlevered farm is 20%. KD is 10%. KD is 10%. KD is 10%. So required, number 1, what is the value of the levered farm's equity? What is the value? What is the value? What is the value of levered farm's equity? Of levered farm's equity. Of levered farm's equity. Levered farm's equity. Let's start with this. What is the value of levered farm's equity? Are we writing something, or you want Mwalimu to do the question directly? You want Mwalimu to do the question directly, or do you want Mwalimu to give you time? In the interest of saving time, because I know everybody here knows how to do this question. So in the interest of saving time, let Mwalimu do this question. So you see here, what do they want me to do here? They want me to value an organization. They want me to value an organization. And how do we value organizations? If, for example, today, somebody tells you that you shall receive a cash flow, you shall receive a cash flow of 10 per annum, and then you are given cost of capital as 5%, and then N is infinity. N is infinity. So cash flow is 10 million, N is infinity, cost of capital is 5%. How do you get value of this firm? To get value of this organization, you'll basically need to get present value when N equals infinity. And if you remember, when N is infinity, we basically take the cash flow amount divided by, is there somebody who is able to remember this formula? You take amount, you divide by what here? R, because we don't have growth rate here. So you shall be able to come and talk of what here, 10 there, divided by the 5%, like that. The same case, ladies and gentlemen. Here I'm seeing a tax rate. They want me to value a levered organization, but I know there is no way I will start by valuing a levered firm. Always start by valuing an unlevered organization. And this is where the trick falls. We shall always start by valuing an unlevered organization. So value unlevered organization first. So we are saying here in the solution, value unlevered company first. Unlevered company is the company without debt. No debt, no interest. And how do we value this? So value of unlevered will be the amount we shall receive, what we call the EBIT. If you wish, you can say minus interest, but you see we don't have interest here. We don't have interest. So in this case, it will be EBIT into 1 minus who? Tax. And then the cost of capital of an unlevered firm, the cost of capital of an unlevered firm is always called a Q. Is always called a Q. Is always called Q. Is always called a Q. Is always called a Q. Is always called Q. So like the one that we did, remember, one of the assumptions of MM is that the company will be a going concern in the long term. Right? Will be a going concern in the long term. N is infinity. So you're taking amount divided by cost of capital. Cost of capital. So have they given me EBIT here? Oh yes, EBIT is 151.5. EBIT is 151.5 times 1 minus tax of 0.34 all over Q. All over Q. So what is our Q here? Cost of equity of an unlevered firm is 0.2. Cost of equity of an unlevered firm is 0.2. So are you able now to give me value of this unlevered firm? Are you able to give me the value of the unlevered firm? Are you able to give me the value of the unlevered firm? Somebody get the numerator first, and then you divide by 0.2, give us a figure. So they're saying it's 500, right? And says 500. At least this one, everybody would have gotten. So this is the first thing we do. And then after now, you have valued the unlevered firm. Now go to the second step and give us a value of levered. A value of levered company now, VL. VL. And if you remember very well, VL, ladies and gentlemen, VL, there is this formula that we must always remember. VL equals V plus DT. Very important formula. If I were you, I would have underlined this and of course used a yellow highlighter. Yellow highlighter. Yellow brings out things very well. Right? So you're saying, so we have here value of a levered organization equals value of unlevered plus debt times what here times T. It doesn't matter whether it's a MM1 or MM2. This is the formula we always use. This is the formula we always use. And you guys have told me that value of unlevered here is 500, the one that you got up here. which I'm seeing somebody saying is 499, which is okay. 499 or something. So 500 plus D, which is what here? D, debt. Debt is 500 here, times the rate of tax, which is 0.34, which I'm seeing somebody giving me 600 and who? 670. 670. All right. So after that, what do you think will be the third step? The third step, you break down value of the levered into debt and equity. Break down value of the levered into debt and equity. Break this down, break this down, break this down. Unfortunately, we know the value of debt. Break this down. Break down the value of the levered into debt and equity. So we have here value of levered equals 670 breakdowns, breakdown. So we know that debt in this question, debt has been given as 500. So then what will be the value of equity given that the two must add up to 670? What will be the value of equity, somebody? 170. So equity will be 670 minus 500, which gives us 170. That is the first thing that you needed to have done in this question. That's the first thing that you needed to have done in this question. So what is the value of the levered firm's equity? That was the question. So the value of the levered firm's equity is 170. Is 170. Yes, Macharia, good question there. Always in Modigliani and Miller, we shall always start by valuing unlevered. If you start with the levered, that automatically is a step in the wrong direction. Utapata mashida mingi sana. Great. So number two, this was the first requirement. The second requirement, number two, what is the cost of equity? What is cost of equity of the levered company? What is the cost of equity of the levered company? What is the cost of equity of the levered company? What is the cost of equity of the levered company? So in MM1, no taxes. In MM1, no taxes. Good question. Remember in MM1, we normally say value of a levered firm equals value of unlevered firm. This is normally the concept. But you see, it comes from here. Because you see when tax is zero, that time, it basically, what I normally tell my students, this formula is just one. There are no two formulas about this. Only that when we go to MM1, we know that tax is zero. So levered firm and unlevered firm will be the same. Great. So then they want us to give them the care, the cost of equity of the levered organization. Unaweza ama uwezani nayo? Unaweza ama uwezani? Unaweza ama uwezani na hii? Very important for your exam. Very important for your exam. What I know, ladies and gentlemen, there are very many ways that you could make use of to get this. But the best of them all, when they ask you to give them care, always tell them that care is Q plus Q minus KD. And then outside here, we have times debt over equity times 1 minus tax. A very important formula. Very important formula for getting care. Very important formula for getting care. Cost of equity over a levered organization. It's Q. Q plus Q minus KD times D over E into 1 minus tax. So is there anybody from this question that we have here? Is there anybody who is able to see Q? Is there anybody who is able to see Q? Q is cost of equity over unlevered firm. Cost of equity over unlevered firm. It's here, it's 0.2, 20%. So you're right. So 0.2 plus Q again 0.2. How about cost of debt? Cost of debt, are you able to see cost of debt? Cost of debt is 10%, which is 0.1. Let me ask you a question. If, for example, today you are to be an examiner, instead of cost of debt, if you want your students to fail, instead of cost of debt, which other language can you use? In this scenario, which a bright student should be able to pick that, hey, this is my cost of debt. Risk-free, yes. Just give them risk-free. The moment you do like that, you'll be able to throw some of them under the bus. You'll be able to throw some of them under the bus. So risk-free is the same as what here? Is the same as KD. So times debt, is there somebody who is able to see debt of this levered farm? Is there anybody who is able to see debt of the levered farm? Debt of the levered farm is 500, isn't it? 500, 500, 500 over equity. Equity of the levered farm is 170 times, we have here 1 minus 0.34. So mimi nitanyamaza, wewe uende pole pole, lakini kama ni mimi wewe, naanza na hii kwa bracket, hizo bracket hizi. Kama inajua itakuwa 0.1, ile inajua itakuwa 0.66. Kwanza deal na pande yote. Sema 0.1 times 500 over 170 times 0.66. Ukishapata answer, you add it to 0.2. 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 We use the long formula, not the shorter one. Always use this formula. Use this formula. I don't know whether it's short. Always use this formula. Use this formula. Always. Always. Now we don't have the luxury of defining two formulas. Now we are going to die with one formula. We shall die with one formula. So I'm being told 39.4. 39.4, yes. 39.4. Now we are dying with one formula. 9.4. 9.4%. And then lastly, they want us to give them the WACC of the levered farm. The last one, WACC of the levered farm. WACC of the levered organization. WACC of the levered organization. So WACC of levered company. This is number 3. Number 3. So of course we know that work equals weight of equity, cost of equity, plus weight of debt, cost of debt, into 1 minus what here? 1 minus tax. All right. Already you can see Lucy Allen has the weights. Thank you very much. So out of this, I should be able to get the weights really. Like now here, look at this. Weight of debt of a levered farm will be 500 divided by 670. How about weight of equity? It will be this 170 out of the total value. 2 decimal places, please. 2 decimal places. Give me those weights. 2 decimal places, please. Give me those weights. 2 decimal places. If you shouted in your mind, wakaka, give yourself a thumbs up. You are a hero or a heroine, right? So according to Charity Mwangangi, I mean 0.75, 0.75, 0.75, and then we have 0.25. Are these figures correct? Can someone else confirm these figures? Are they correct? Yes, thank you very much. So then come here and remind us, this wakaka, weight of equity. Are you able to see the weight of equity? Are you able to see? Will you get somebody here out of nowhere picking 0.75? No. The weight of equity is 0.25 times cost of equity, please. Ole wako ukichukua tikeu hapa, and yet you're working with a levered farm. This has to be KEL, and the KEL is the one that you guys have given me as 39.4%. That is the KEL. And then we have the weight of debt. Weight of debt is 0.75. KD is what you guys give me as 10%. Times 0.66, because 1 minus 34%. 1 minus 34% is 0.66, like that. Oops. Sorry for that. Yes. Okay. Great. Great. So they're getting, in this case here, 14.8. They're getting 14.8. Now, let me ask you a question. According to you, given this 14.8, is that good or bad? Is that good or bad? How do you cram the KL formula? Just like the meow, K plus K minus KD times debt over equity times 1 minus T. And then Modiani, it will be very important for you to just highlight this formula. Then after this class, ensure that you do what here, you repeat this question. Try to write it somewhere yourself. Try to write it somewhere yourself. It could be very important. Yes, try to write it somewhere yourself. So is that okay? 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 So there is one thing that you guys haven't yet answered me. Is that good or bad? So in this case here, you look at the WACC of the unlevered farm. Start from there. WACC of the unlevered farm. Look at WACC of unlevered farm. Nobody will ever give you this, but you as a bright student, you know that WASHU always equals K. These are very important. WASHU always equals K. WACC of unlevered farm equals cost of equity of unlevered farm. So therefore, our WACC over unlevered farm, if you remember, our K was 20%. So it was 20% here. And our WACC over a levered farm, WACC over a levered farm has really reduced. It's now 14 point. Anything that reduces our cost of capital is worth pursuing. So debt is very good. This is according to MM2. Debt is very, very good because it leads to increase in farm value and reduction of the company's what here, WACC. Reduction of the company's WACC. Great, great. Okay, Kenya, Uganda. I'll look at this later. But for me, this is and because I know that this is an area that you guys can't really, this is an area that you guys can't afford to miss in your exam. Let me first of all try by giving you a very simple question here. Just a very simple question. Very simple question. Now, in these questions and gentlemen, we are given KD, exercise 2. They have given us KD is 8%. This is a very simple question. Everybody will be able to get this right. Q is 10%. Q is 10%. Debt is 1,000. Value of a levered farm, 7,300. Required, number 1, KEL. Number 2, WACC of a levered farm. Those 2. In 3 minutes, we should be able to finish those 2. I'm not producing accountancy, I'm producing artists. We shall overcome. Tax, I forgot about tax. I forgot about, how could I forget tax already? Tax is 30%. Tax is 30%. Sorry for that. Tax is 30%. But of course, in an exam, if it's not given, always take it to be 0. Take it to be 0. But in this case, it was given. And the one who did a mistake, it was given. Yes, if you're given, use MM1. Use MM1. So in the interest of time, I think I'll do the question. I really wanted to see whether John Mudhiani has been able to cram the KL formula. Okay, so they are correct. I can see here they are correct, 10.22. So remember, what a good student will do even first here, when they give me value of a levered fund, I'll come and break it down. I'll break it down into debt and equity. So the debt has been given here. The debt has been given here as 1,000. So equity will be 7,300 minus 1,000, which will give me 6,300. And out of this, then I should be able to get weight of debt and the weight of equity. So weight of debt will be 1,000 out of the total 7,300. Weight of equity will be 6,300 out of 7,300. Could you kindly give me these figures in 2 decimal places? Kindly give me these figures in terms of 2 decimal places. In terms of 2 decimal places. Please give me these figures in terms of 2 decimal places. I know I don't need them in part 1, but just a way that I'm used to. When I see value of a levered company, always break it down. Value of a levered company shall always be broken down. Shall always be broken down, always. So somebody tell me 0.14. So this is 0.14, and then we have 0.86. Thank you very much. These are low-hanging fruits. These are low-hanging fruits. I'm harvesting them. 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 I am harvesting them. Ladies and gentlemen, after that, I should be able to get the KL. I should be able to get the KL here. I should be able to get the KL here. So then how do I get the KL here? To get KL, I know the formula. KL, I know the formula. I know how to get KL. I know how to get KL. John Mudhiani, KL is KU minus, not minus, but plus. KU minus KD, minus KD, minus KD into debt over equity times 1. And by the way, in your exam, at times the examiner may not give you the values here. If you're not given values, it's okay to use WD and WE. It's okay to work with weights. You'll get the same answers. It's okay. So KU in this question is 0.1 plus KU 0.1 minus KD. KD is given as 0.08. 0.08 times debt. Debt is 1,000 all over equity, 6,300 times 0.7. Are you able to see where I got the 0.7 from? Are you able to see where I got the 0.7 from? 1 minus 30%. Thank you very much. So therefore, KL will be equal to who? Our KL will be equal to who at the end of the day? Our KL will be equal to 10.22, the one that was given to us. 10.22, 10.22, 10.22%, like that, 10.22%, 10.22%, of which I'm so sure all of us really would have gotten this. Nobody would have lost these 3 marks. So after this, then they want us to come and give them the WACC, the work. So work, we know the formula. It is weight of equity, cost of equity, plus weight of debt, cost of debt, into 1 minus tax, into 1 minus tax, into 1 minus tax. All right. So the weight of equity, already we have the figure. We have the figure, weight of equity was coming to 0.86. So we have here 0.86 times cost of equity. Cost of equity is what here? It is a KL. It is this 10.22%. Plus weight of debt, 0.14 times cost of debt. Cost of debt is 8% times 0.7 like that, times 0.7 like that, times 0.7 like that, times 0.7 like that, 0.7. So then somebody should be able to give me the final answer of the work. I'm being told it's 9.57, 9.56. Thank you. So hii kitu msinilet down kwa mtihani. Msinilet down kwa sana. Hii low hanging marks ni mzuri sana hii. Now there are things that I would want you to go to your exam knowing. This proposition of MM2 proposition, very important. The conclusions basically here. The conclusions basically here, that is, of course, this with tax. The conclusions here were, number 1, that value of a levered farm is always more than value of an unlevered farm. Very, very important. Value of a levered farm will always be more than value of an unlevered farm. Very, very important conclusion. Then number 2, we have a very important conclusion in the form of a formula. That the value of a levered farm will always be equal to value of an unlevered farm plus DT. Then number 3, we have another very important formula of KL. Of KL being equal to Q plus, we have here Q minus KD into D over E times 1. This is a very important conclusion. But the cost of equity of a levered farm will keep on increasing. And this is the formula. This is the formula. And then lastly, we have here number 4, WACC decreases as debt increases. As debt increases, as debt increases. Have you written these conclusions? I mean, it's high level, high level. Even if you remember just 1 out of 4, great, great. At least you have something, isn't it? What I would not wish to see are my students, in this case, they will be gazing at the ceiling. If we come at the exam room and we find you gazing at the ceiling, waiting for manna from heaven, then we should be able to punish you a little bit. We should be able to punish you because you should be having a lot to write, really. Should be able to have a lot to write. Great, great, great. Press up, sir. Yes, we should be able to have some kind of assumptions of M. Assumptions of MM without taxes. What should be the first assumption here? What should be? No taxes, isn't it? No taxes. Good. No taxes. Very important. Personal corporation taxes, 0. Number 2, no transaction cost. Number 3, individuals and the corporates borrow at the same rate. At the same rate. Meaning that KD is known in advance and will remain constant for individuals and the corporations. Number 4, no bankruptcy costs. But you can keep on borrowing as much as you wish. As much as you wish, you will never become bankrupt. You will never ever become bankrupt. You will never ever become bankrupt. On this note, do you guys believe in borrowing individually? Do you borrow excessively? Do you borrow excessively? Yes. 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 Wisely, eh? Yeah, you need to borrow so that in case you die, quite a bad topic. We should be having two kind of people will be coming to that barrier. Eh? Yeah, the relatives will be saying, you know, you have lost a dad, you have lost a mom, ETC life will be quite deep. But also we should be having people that you have died with their debt, right? With their debt, seriously. Yeah, seriously, seriously, seriously. And on this note, are you aware that Muhasibu Sacco is a very good Sacco? Muhasibu Sacco. Are you aware that Muhasibu Sacco is a very good Sacco, that all of us should be members of this accountant Sacco? Yeah, I'm in. I'm a member. Great. Yes, yes. Especially this product that they have a very good product of mortgage. Yeah, mortgage. Where in this case here, you will take 8 times of your contribution. 8 times of your, so if you have like 2 million in terms of shares there, you take 16 million. 8 times of your contribution. And that property will be used as what here? As your collateral. You use it as collateral. You don't need guarantors from out. Never believe in this thing of guarantors. People guarantee, you guarantee them, they run away. You lose all your shares. Always guarantee yourself with your assets, vehicle, etc. Now, the good thing with this, once you take the 16 million, the repayment period is 12 years. 12 years. So the repayment again goes down. So it's a very, very good Sacco, but many people don't know about Muhasibu Sacco. As other Saccos are giving like 3 times, like Steamer Sacco, Muhasibu Sacco will be giving 4. And in most cases, they give up to 5 for the normal loans. 5 times, you call it. Great Sacco. Great Sacco. They can't match Muhasibu. Me, I'm a member of even Steamer. They can't. Muhasibu has got very good products. Very good products. Very good products. Very good products. Mashamba ndio wameharibu kidogo. Kumbuka kitambo walikuwa wanakuja na mashamba mzuri kama ile project ya Runda. Wanunua shamba Runda. Lakini siku hizo wameanza kuwa waerevu. Wakienda huko ndani kwa sijui ni Malama ni wapi wanauza shamba 590. Wameanza kuwa waerevu zaidi. Wameanza kuwa waerevu zaidi. So no bankruptcy, so borrow quite a lot. Borrow quite a lot. And then of course we have the concept of what here? EBIT is not affected. EBIT is not affected. Is not affected by use of what here? That EBIT for the two firms, either in this case unlevered or levered, EBIT will always be the same. EBIT is not in advance and will remain constant throughout. EBIT never changes. And then of course we have got debt, equity, etc. It's only debt stroke equity like that. Now, ladies and gentlemen, I'm not yet finished with you. I'm not yet finished with you in terms of Modiganila. Let me just do one more question here from your past paper. I would want to do the easiest question. Don't ask me why I'm doing the easiest. November 2016, question 3. November 2016, question number 3. November 2016, question number November 2016, question number 3. November 2016, question number 3. November 2016, question number 3. But Paul, I know you're married. What's not happening, Paul? Or there is nothing wrong with that? And you're also very busy. Will you get time for two wives? So here, we shall overcome. We shall overcome. We shall overcome. Great. Okay, okay. So, Sasa, November 2016, question number 3B. November 2016, question number 3B. These are very important question. Question number 3B, very important question. Maju Limited is just about to commence operations as an international trading company. The firm will have a book value of assets of shillings 320 million. And it expects to earn 16% return on these assets before interest and taxes. So I'm able to see straight away what I will earn before interest and taxes will be 16% of the assets that I have there. 16% of 320. Return on these assets before interest and taxes. Can somebody give me the EBIT? EBIT is very important to me. EBIT is very, very important to me. EBIT is very, very important to me. 16% times 320. This gives me 51.2. This gives me 51.2. So that's a free mark. Not many students will be able to get EBIT. You know, there is no way you'll be able to do Modigliani Miller questions without EBIT. EBIT is your base. So, however, because of certain tax arrangements with foreign governments, the company will not pay any tax. It is known that capitalization rate for an equity firm in this business is 12%. Capitalization rate, cost of capital of an all equity firm, that must be KO. That must be KO, which is 12%. That must be KO, which is 12%. The company can borrow debt finance at the rate of 7% per annum. That is KD. KD is 7%. Unachoka vitu yako pole pole. Pole pole. Nazipanga. Pole pole. The management is in the process of deciding how to raise the required 10 million debt. So debt amount is 10 million. You know, even by writing like this is a milestone. Because many times when you're marking AFM papers, they are normally water blank. They are normally blank. Right? Assume that Modigliani and Miller assumptions apply. Using model without taxes, determine the current value of the unlevered firm. Hapa imagine, Lucy, hakuna kizungu hapa. This is very straightforward. So they want you to get value over this unlevered firm. I'll not even worry. I know the formula is the same. EBIT will be constant like that. It's my cash flow. I would want to come and I would want in this case to come and discount. So I'll say value of unlevered firm equals EBIT into 1 minus tax all over K. Kwani iko nini? Stakram vitu mingi mimi. Hiyo ndio formula. EBIT najua EBIT hapa ni 51.2. Najua 1 minus tax. Anasema without taxes. Sinajua ni zero. Right? Tax is 0. And have they given me KU? Yes, it's 0.12. Nimeshadunga max. Nimesonga mbele. So according to Bwana Duncan, 426. Hizo 6 ni mingi sana Duncan. 6 Duncan mingi sana. 426.67. 426.67. 426.67. 426.67. 426.67. 426.67. Thank you very much. Now, please go to number 2 of the question. Number 2 of the question, they want us to give them the current value over a levered farm if it uses that 10 million debt. Unaweza ama huwezi? Unaweza ama huwezi? If it uses 10 million debt, value of a levered farm. Tunaweza. Thank you very much, Millicent. Is there a student who is attending this particular class of this funny lecturer for the very first time? That this is the very first time you are seeing this man. Any student who is attending AFM for the very first time with this man? Oh. At least we have one, eh? Oh, Rich also. Ah, great. 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 Without tax. Without tax. You, my own, read this slowly. The current value. Oh, but you see, without tax, my own, without more is an old single mind. Without tax is the same as saying tax is 0. Tax is 0. It's without tax. Even me, I've handled it without what? I just wanted to show you that you don't have to cram so many formulas. We don't have, even the one that you guys are cramming there. Duncan is saying that he got 420.83. 420.83. The lady is saying no, right? So like if I'm the one doing this, I know this is Modigliani Miller. And if he's Modigliani Miller, if he is 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 Modigliani Miller, I know number 2. Value of a levered farm will always be equal to value of a levered. So we come and say value of a levered farm equals value of unlevered, which is 426.67 plus debt. Debt is 10. And because they have told us without what? Taxes, I'll use 0 there. I'll get your answer. I'll get your answer. So at the end of the day, what figure are we getting at the end of the day? Wala ambao kuna figures tofauti, wala kuna figures tofauti kidogo. Wameona mahali ambao wamekosea, wameona mahali ambao walikosea. Wala kuna figures tofauti kidogo. Are you able to see where you guys went wrong? Are you able to see where you guys went wrong? No, how about interest? So long as there is no tax, there is no interest tax shield, no interest tax advantage. This is it. Ama ukramile wafunza wamesema, without taxes, value over a levered farm equals value of unlevered farm, because this will die. Great. Great. Now from there, ladies and gentlemen, please move the last one, the WACC. I love WACC a lot because I know that the very first thing when they want me to give them WACC is to come and break down value of a levered farm. Break down, break down, break down, break down, break down, break down value of a levered farm. Break down value of a levered farm. That's what you do. So unakuja mwandikia hapa uye value of a levered farm equals 426.67. You break down, you break it down. Unasema debt equals who and equity equals who. What is the amount of debt in this question? What is debt in this question? What is debt? Debt is 10, isn't it? Debt is 10. And if debt is 10, and this is a total value, then what will be the equity value? 416, isn't it? Because the two must add up to 426. So equity will be minus 10. So abracadabra, please go ahead and give us the weights. Abracadabra, go ahead and give us the weights. Go ahead and give us the weights. Yes, I like that summary. Paul, I like that summary. I like that summary. I like that summary. Great. Kizungu mingi hatutaki kwa hii mambo. Una summarize the data namna hiyo. Ukisha summarize, then that is it. So weights, are you able to give me the weights very fast? What shall we do to get weight of debt? You take 10 divided by 426.7. Then weight of equity, we have here weight of equity. This will be 416.67 divided by 426.67 equals like that. So according to Jerome from Rwanda, this is a beautiful thing with online classes. We have students spread across. So we have here 0.02, 0.02, 0.02, and 0.98. Thank you very much. Thank you very much. So after breakdown, I know that the next thing will be for me to get care, which Lucy has been able to go ahead and compute. So the next thing after breakdowns is to get the care. You get the care. You get the care. So go ahead and get the care. 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 One surprising thing is that since I was born, I've never watched any football match. I don't know whether I'm abnormal. Never, not even a single one. Not even a single one. Not even a single one. And I would never want to watch even one match. I don't want. Maybe I'm abnormal, I don't know. Yes. I've never. Not even the local football. I've never. Ni mko normal. I think mimi niko abnormal. Mimi niko abnormal. Yeah, I agree. I'm the one who is abnormal, yes. I'm the one who is abnormal. I've never seen why I should sit down to watch some people here chasing after dead skin, others making a lot of noise. So Kel, we'll talk about that. So Kel is Q plus, we have here Q minus KD into D over E into 1 minus tax. So could you kindly remind me, what is our Q? What is our Q? What is our Q? Is there somebody who is able to remind us our Q? We have written it up there. It was 0.12 plus 0.12. KD, do we know what our KD is? Cost of debt. Cost of debt, do we know 7%? So 0.07 into debt we have debt here is 10 over equity. Equity is 416. 416.67 times. Tax wamesema ni ngapi? Tax wamesema ni 0, no taxes. So 1 minus 0. You must move slowly there. 1 minus 0. Tax is 0. So then I'm being told at the end of the day that the correct answer is supposed to be 12, according to Jacqueline. Is it exactly 12 or 12 point something? It has to be slightly more than the cost of equity. It has to be slightly more. It cannot be exactly. It has to be slightly more. So I'm being told it's 12.1%. Like that. Thank you very much. So now after that, I know it's about plugging in this formula now in W, this value in WACC. So now go ahead and they give us the WACC. So WACC equals weight of equity, cost of equity plus weight of debt, cost of debt after tax. So weight of equity, you guys did give me 0.98 times cost of equity, which is 12.1%. Weight of debt is 0.02 times cost of debt 0.07, that's 7%, times 1 minus 0, which will end up giving me what figure? Okay. $12.02. So how are we getting the weights? Remember, like in this question, we had the farm value, total value of the levered farm was this. So we split this into two. Debt, itakuwa 10. Equity, itakuwa 426.67 minus 10, which gave us 416.67. And therefore, in terms of weights, weight of debt will be the debt amount 10 over the total value, 426, not 416. Ukija hapa weight of equity, itakuwa this 416, which is the equity amount, divided by the total value, 426. Let's try that. And again, you'll have access to this video, which you can work with. So answer part 2, current value of a levered farm. Somebody help me answering to answer this gentleman there. C, assuming that the company in B above now pays taxes at the rate of 30%, compute the following in a Modigliani and the Miller world. We start with number 1. Number 1, now this is yours. We start with number 1. Number 2, Roman, looks like VU plus VD. No, but we have never seen that kind of a formula anywhere. Nowhere. We know, ladies and gentlemen, my own, to get value of a levered farm, we take VU plus debt times tax. Value of unlevered here was 426.67. Debt is 10 and tax is 0, which kills this. You see 0 multiplied by a number. This number is dead. So that leaves us with 426.67. Okay. So now we should be able to do part 1, the current value of the farm, if it uses no debt. So basically they want us to evaluate VU. I've done. Like to give you 1 minute to try this out, try this out, try this out. VU will be equal to who? Let's see. Yeah, I can see 298. Thank you very much. Thank you very much. Thank you very much. Thank you and thank you indeed. So now, ladies and gentlemen, what we have here, I even don't know why this examiner was leading. A good examiner should never lead students. You need to leave these students here to struggle by themselves. They should need to know, that we shall always begin by giving the examiner value of unlevered farm, which in this case here will be equal to EBIT into 1 minus tax, all over cost of equity of unlevered farm. EBIT is not changing, it's 51.2, we got it up there. So then this one here will be 1 minus tax is 30%. The cost of equity of unlevered farm, we got it up there, it was 0.12. So could you kindly confirm that this will give us 298 point what? 298 point what? Yes, 298.67. Thank you and thank you very much. After that, they want us to give them this one. Not very many students will be able to get this. Not many students will be able to get this. Number 2, they want us to give them. The current value of the farm if now it uses debt. So people trying to use very big formulas. No, under Modigliani-Miller environment, I should always know that value of a levered firm equals value of unlevered plus debt times tax. Right? So then the value of the unlevered here is 298.67. How much debt is it borrowing? How much debt are we borrowing here? Thanks, Emily. Thanks, Adan. 10 million. So 10. And the debt tax itself is 30%, 0.3. So here you move slowly. This is 3 plus this. You give me 301.67. 301.67. Even without now being asked, I know that the next thing will be for me to split. Always a levered farm must be split. A levered farm must always be split. A levered farm must always be split. So let's look at the next question. The next question is WACC. I'm not stupid. I know before I answer WACC, there are two things I have to do. There are two things I have to do. The first one, before I answer WACC, we have to split this organization. We split the organization into debt, stroke equity. We split it up. So split the organization. Split the organization. Split the organization. Right? So value of a levered farm is 301.67. I'm splitting it into debts and equity. So debt will always be provided. In this particular case, debt is 10. So then equity will be 301.67 minus 10, which will give us what figure? 291.67. So then out of this, upon splitting this, I know I should be able to get the weights. This has woken up when we're almost finishing the class. Better late than never. So weight of debt, this will be 10 divided by total farm value, 301. 301.67. Right. This will be 291.67 divided by 301.67, which will end up giving us what figures, ladies and gentlemen? So the first one, I'm being told is 0.03. 0.03. That is the first thing I'll do, split. After splitting the organization, the next thing will be the CAL before I get WACC. So come and give us the CAL. Give us the CAL here. Give us the CAL. Give us the CAL. Give us the CAL. So CAL, we know the formula, it's Q plus Q minus KD into debt over equity into 1 minus tax. So then what is our Q in this question? What's our Q in this question? Q cannot be 12.1. Q. Cost of equity of unlevered farm. So in this case, you want to say, oh, maybe that's the final answer. So Q is 12%, the same as 0.12. All right, plus 0.12 minus KD of 0.07 times debt. Debt is 10 over equity, 291.67 times 1 minus 0.3. I think I'll put the final answer. The final answer is quite close to whatever we have because of, you know, the debt is almost, this is almost zero. Debt 3% is almost zero. So you expect whatever CAL we have here to be the same as Q, almost. So ambao wameenda mpaka mwisho wanasema ni 12.1%. Is there somebody who is able to get this figure? 12.12, at least to make it a bit different. 12.12, thank you very much. 12.12%. So now what do you think will be the next thing to be done after getting this CAL? What do you think will be the next thing to be done after getting the CAL? After, yeah, the work now. So now you can give us the work comfortably. You can give us the work comfortably. You can now give us the work comfortably. You can now give us the work comfortably. What I know, the moment you have mastered this WACCs, whatever, you mastered the Hamada model, right? Right? You have already covered about 40% of your exam. And I'll tell you why I'm saying that. These are very important thing, very important thing. So then WACC will be weight of equity, cost of equity plus weight of debt, cost of debt into 1 minus tax. The weight of equity you guys have given me 0.97. The CAL is 12.12%, 0.03 times KD 0.07, which is same as 7%, times this is 0.7. Would somebody tells me that our WACC is supposed to be 11.90, 11.90, 11.90, 11.90, 11.90, 11.90, 11.90, 11.90, 11.90.